Well, hello, everyone, and welcome. My name is Robert Miano. I'm the Chief Executive Partner for RSM Australia, and I'm delighted to have you join us for this special economic update. I'd like to begin by acknowledging the traditional owners and custodians of the land in which I'm joining you from today, the Wurundjeri people of the Kulin Nation. I pay my respects to elders past and present, and I extend that respect to all Aboriginal and Torres Strait Islander people joining us today. Well, uncertain times demand clear insight, and that's exactly what we're about today. As we look ahead to 2026, the economic landscape feels less like steady ground and more like shifting quicksand and a minefield. And over the past few months, we've seen quite a lot of developments, both in Australia and globally, that are reshaping those business conditions in real time. Here in Australia, unemployment has nudged higher, inflation released earlier this week remains high in parts of the economy particularly, and the RBA continues to balance that slowing demand and persistent price pressures. Some sectors are beginning to feel the strain quite acutely, while others are showing unexpected pockets of resilience. And the United States is navigating its own challenges, continued uncertainty around fiscal policy, tensions with major trading partners, and volatility in energy prices, the implications of prolonged government shutdowns, which ended last week after 43 days, and global markets, as always, responding sometimes calmly, sometimes sharply. The movements aren't happening in isolation. They're influencing capital flows, investment sentiment, hiring plans, and industry performance locally, the US, and globally. For business leaders, owners, investors, everyone who's on this call, like many here today, trying to understand those shifts are critical in the decisions we'll make into the future. And we're very fortunate to help us make sense of it all. We have two leading economists joining us today who both spend every day immersed in these developments. We're very privileged to have Joe Brusuelas here with us, the chief economist from RSM US, widely regarded as the chief economist of the middle market. Joe will offer sharp insights into the latest economic and policy dynamics shaping the US markets. He appears regularly on BBC, Wall Street Journal, New York Times, and has been rated one of the best forecasters by Bloomberg. Then we have our very own Devika Shivadekar, our economist from RSM Australia, who's a regular face and voice in the AFR, ABC and SBS, and Devika will unpack how recent developments here and abroad are likely to shape Australia's economic outlook. This won't be a straight presentation, it's more in the form of a live discussion, so please post your questions in the Q&A panel throughout the session, and we'll weave the questions into the conversation as we move through. But before we dive in, we'd like to get your read on the economy and the challenges you're facing. We'll start with a quick poll. And if you could please take a few seconds to answer the two questions that have appeared on your screen, and then we'll commence the discussion. So whilst that's starting, thank you for contributing to that. We'll show the results of that later. We'll start with an overview of both economies. And Joe, would you be able to walk us through what's happening in the US economy at the moment and what's driving the mood over there?
All right, so I want to start with the global expansion and integrate the US into that discussion so it's not so American-centric as too many things are across the global economy. You know, the global expansion stands at a critical juncture. It appears global GDP expanded by 2.3% this year. Now, that's pretty good following the pandemic era shocks. But prior to the pandemic, Devika and I would have told you, well, that's consistent with a global recession. Now, I think that front-loaded stimulus out of the United States and China, as the trade war cools a bit and we settle into an effective tariff rate out of the United States of somewhere near 17%, by early 2026, we should see global growth expand next year at a 3% level. Now, that will be above the 2.3% to 2.5% I'm expecting out of the United States and probably somewhere between 4.5% and 5.5% in China. What's driving global economics right now? Well, clearly two things. It's the resetting of expectations around inflation and interest rates following the shutdown of the global supply chains that occurred 5 years ago. Quite simply, there was a status quo ante of what the global economy looked like on December 31st, 2019, and what it looks now. We're all, and I mean all economies, are essentially resetting to expect stronger inflationary pressures and higher interest rates. Why is that? Two reasons. One is the global supply chains simply didn't reopen the same way. They were permanently altered, and we're all still adjusting. These things were built over 30 years, and it's not going to be repaired overnight. Second, there's an increasing intolerance by the developed economies of absorbing the flooding of the zone by China of its overproduction, specifically around automobiles and other value-added goods. China is proceeding through what looks to be a 7 to 10 year debt and deleveraging crisis having to do with the crash of its residential and commercial property sector. The Chinese are very keen on protecting their labor base and their employment market, especially in areas of industrial production. Quite simply, they're choosing to flood the zone, the global zone, with the overcapacity of goods, demanding that their trade partners take a smaller share of global manufacturing so that China can slowly work its way out of what's a very difficult situation. It's to the point where the United States and the Europeans are basically very close to just outlawing Chinese automobiles from entry into their markets. In the United States, the attempt to rebalance global trade into conditions that favor the U.S. looks like it's about to peak, and I would expect it to cool materially in 2026 as we approach the effective tariff rate in the United States of somewhere between 17 and 18%. As of November 13th, the effective tariff rate on all U.S. trade partners is around 14.36%. Australia has a 6.54%, which puts us in the lower range. So while that's much higher than the 30-year average, it's nowhere near the 30.75% average on China, the 35.18% average on India, and the 31.23% average on Brazil. While those for Brazil may go down, I'm uncertain about the direction, whether it's easing a bit or rising on both China and India. Now, next year, I expect India to be the primary driver of global growth, as it has been, but no longer 7 to 10%, probably more in that 6% range as India adjusts. Now, one of the big tailwinds in 2026 is going to be the global oil glut, which is certainly going to help on inflation, certainly going to help on pricing overall in all sorts of different ways. And I think that's something you want to take a look at. Should the Ukraine-Russian war be wound down or find a steady or unsteady truce, you should expect Russian oil to re-enter the market, and we could see oil prices in the mid-40s as opposed to the mid-50s to mid-60s. In the United States, you're going to see large tax cuts, interest rate cuts, full expensing of productivity enhancing capital investment. It's investment in software, equipment, and intellectual property, as well as very significant banking regulation, all increase risk appetite. Now, because of the trade war, that shaves about 1% off of potential growth. So if the United States is going to grow 2.3 to 2.5%, that just gives you a sense of the front-loaded fiscal stimulus that's in train. The unemployment rate will rise. We think it will rise temporarily to 4.7 to 4.8%. Then as the stimulus is unleashed and hiring picks back up, it should slow back to around 4.5%. Historically very low and just above full employment, which would be at 4.3% in our estimation. we expect the Federal Reserve to cut interest rates 1 to 2 more times, probably about 50 basis points in total, which will bring the federal funds rate to 3.5%. Again, that may not seem like much, but in the large, dynamic, and resilient beast that is the $30 trillion US economy, that will move financial markets. Moreover, there's something extraordinary going on in the United States that has to do with the deployment of artificial intelligence, the construction of data centers, and the early stages in the construction of the energy complex to support it has resulted in, during the first half of this year, fixed investment by 10 companies has resulted in about 20%, has accounted for about 20% of GDP. That's an enormous number. It's $380 billion on the table this year, and we think by 2030, anywhere between $3 and $5 trillion. So while the United States is going through an enormous transition, it faces extraordinary challenges on trade, self-inflicted wounds on immigration, right? Large debt and deficit dynamics. What's occurring is productivity is beginning to shift up and to the right. When that occurs, interest rates can stay a little bit lower than they otherwise would be. Growth's dynamic, and what you get is capital entering the United States, even though firms have to hedge currency volatility while they do so.
Yeah.
That's going to alter the underlying dynamics of the global economy as countries begin to compete with the US to integrate this transformational technology. So that's sort of my view on 2026 on the global economy. 3% growth, a good pickup. Trade tensions continue, but should ease, while the US economy and China front load large fiscal stimulus that drives the global economy, while India continues to outperform.
Excellent, Joe. Thank you. And Devika, some of what Joe mentioned about China and India obviously has an impact on Australia. How's the Australian economy performing at the moment, and what are the main trends and indicators that we're watching?
Yeah, thanks, Rob. So Australia has, as you always say, we are a lucky country. So we have been unexpectedly resilient even throughout this turbulent times, going as far back as the pandemic. A couple of points that Joe touched upon being that we opened up much sooner than the rest of the world, which meant we had the problem of inflation if we go back 3 years ago. How we dealt with it has resulted in where we are today. So we were late to the party to hike interest rates. Understandably, we are late to the party to start cutting interest rates. Now, how we have developed so far is ever since the tariffs have been announced, we have fortunately been at the lower end of the tariff zone, and now it's 6.4%. It's among the lowest. On top of that, some of our core commodities, beef, which was slapped with 10%, the tariffs have been removed. So that's a big win for Australia. While we were suffering from, say, the tariffs, as well as the pandemic-driven slump in consumption, in private consumption, the public sector picked up the slack. We had a lot of growth in public sector investment. We had a lot of growth in public sector consumption. Now, as it happens, both the government and the Reserve Bank of Australia are coming together to curb that public spending. And of course, it's the responsibility of the private sector now to pick up the slack to keep the economy moving. And we have been seeing that happen materially ever since the interest rate cuts that were delivered earlier in the year have now started filtering through in the economy. We saw household consumption pick up quite sharply, and we saw that reflected, unfortunately, in our inflation numbers. So there's a growing fear that given the sharp rebound in private sector consumption, there could be a chance that we might just undo all the progress that has been made on the inflation front. So this is how the RBA is going to be, looking forward. Number one, they are going to manage inflation expectations. They want to ensure that people understand that their actions are what actually drive a huge chunk of policy decision. It's not simply numbers, but it's also consumer behavior. So we have to be very judicious about the way we are conducting ourselves. It's a shared responsibility. Growth-wise, I think we have been fairly stable because we've had the public sector and private sector take responsibilities from each other at different times. So broadly, our growth has been quite stable. Of course, when it comes to businesses, it's a bit tricky in the sense that businesses are the first ones to get hit when consumption falls, and also the first ones to be hit when interest rates go up. So the implications are very dynamic, are very real time. Understandably, because of the uncertainty that creeped into the outlook for global growth, we've seen a severe fall in investment plans for Australian businesses, particularly the businesses who have major dealings with consumers in the United States, because understandably the whole point of tariffs was to move the American consumer away from imported goods and services and looking inwards. So that was a risk that most of the Australian businesses were grappling with, and that meant lesser investment plans. That meant perhaps laying off more people in order to safeguard their revenues, which continues to happen. It still continues. We are seeing a lot of layoffs. So when we tie all of these pieces together, we can see that growth is now being prepped up by private consumption, but it's quite sharp, compared to what was previously anticipated. So inflation risks have increased because demand is now outpacing supply. Supply continues to be constrained because businesses are pulling back on their investment plans. And at the same time, there's a growing risk that the labor market might just be loosening too quickly given the number of layoffs that are happening in Australia. On the flip side, in the same labor market, there are certain businesses that continue to struggle because of a massive skill set gap. A lot of businesses are still unable to fill the gap when it to hire the right laborers to fill those skill shortages and improve their productivity, improve their revenue growth. So there are undercurrents. The risks are more towards the downside when we look at the undercurrents, but broadly when we look at a holistic when we take a holistic point of view, I think Australia is doing fairly well.
Good.
Keeping this in mind, I think how the RBA would be thinking is, do we really need to go further? I don't think so. The RBA is not very keen anymore, particularly given that the labor market continues to operate at almost full capacity. We do see some layoffs, but still lack of productivity and lack of being able to find good skilled labor means the labor market continues to remain a bit tight. When that happens, there's always the angle of wage pressures. If there's a limited pool of talented people in the labor market, understandably, businesses will offer higher wages in order to get those people into their fold. When that happens, disposable income is higher because interest rates have gone down, mortgage payments have become easier, price pressures are slowly easing off. So disposable income being higher means spending increases. When spending increases, we have the problem of inflation. So the RBA would be mindful of managing those expectations of those wage cost pressures. And what they would be thinking is, I think we need to put a break. We need to apply brakes now. And the inflation numbers that we saw earlier in the week, now that we have moved from a quarterly inflation series to a monthly inflation series, there's going to be more noise. The result is going to be more real time, more dynamic. So the RBA is actually going to have faster insights into the actual price pressures. Headline inflation, understandably, is quite volatile because a lot of subsidies also flow into those prices. But core price pressures have also been above the RBA's desired target range at 3.3%. So that's not a good sign. Understandably, towards the tail end of the year, we do see a lot of seasonal factors, but what is concerning is a lot of these price pressures over the last 3 months have mostly been driven by discretionary spending, which means people are actually indulging. Now, that's a concern. And that's when the RBA wants to manage those behavioral patterns that it's seeing in consumers. So the RBA would be thinking, okay, we have eased, but inflation is rearing its ugly head again, and it's time we put a break on that. I believe going into 2026, I do not see the RBA cutting any more than 2 times from the data we have on hand today. How quickly things change remains to be seen, but considering that the tariff tension that had started in the beginning of the year has now started easing. The pressures on Australian commodities, goods, and services being exported to the United States, the pressures easing, the outlook is going to be more optimistic than pessimistic. So to balance the optimism from the global outlook versus the pessimism in the domestic outlook is it's what's going to drive the entire 2026. And we believe we have entered an era of higher cost of borrowing for both businesses and consumers since the last 2 years. And I don't see that changing anytime soon. To expect interest rates in Australia to go back to emergency settings during the COVID time of 0.1% is honestly it's unreasonable. That's not going to happen. So we are currently at 3.6, and we expect the RBA to only cut two more times, perhaps two more times by 25 basis points each. That's our base case going into 2026. Perhaps the RBA might see the data and feel comfortable doing that at its first meeting in 2026 in February. But our risk profile is more tailored towards that being pushed back rather than being brought forward. So to sum it up, growth is now all about the private sector actually picking up the slack. At the same time, we do require businesses to actually go ahead with their investment plans. We see that happening because business conditions are improving with the changes in the global factors. Confidence seems to be improving as consumers start spending higher. So broadly, the picture shows one of positive business investment. Consumers, understandably, are quite happy with the way interest rates are settled, but it's important to rein them in, which is why we do not expect the RBA to be very generous with its cuts. The labor market, last but not the least, is a very, very important part of the puzzle. And we do see a lot of layoffs. We are aware that it's happening, but at the same time, the lack of skill set in the available pool means there are still some underlying pressures, which means we still have the risk of wage pressures in the labor market. So broadly, we do expect Australia to remain resistant. And I think we can expect annual growth to average around 2% in 2026 and the unemployment rate to average somewhere around 4.3 to 4.5%, somewhere in the middle, depending on which sectors experience layoffs, which sectors experience a higher intake of laborers. Inflation, I believe, we do expect it to average, headline inflation to average around 2.5, closer to the 3% mark in 2026. But it is supported by easing goods price pressures and government subsidies. But there's a significant risk from tradable inflation and currency. So I would expect both headline and trimmed mean to trend anywhere on the upper side of RBA's target range, not closer to 2%, but above 2.5%.
Devika, what's interesting about that is with globalization continuing, global trade's actually rising, but it's also fragmenting as the Chinese and the Americans insist on drawing sides and forcing people into their respective trade orbits. And, many ways, Australia's got it better off when it comes to inflation because core inflation globally has been 3% for the past 2 years, compared with around 2% or less for many years prior to the pandemic. Inflation in the US is going to continue around 3 to 4% for the next 2 to 3 years at the very least. There's a metric the Fed uses to set policy that's going to be a little bit less, around 2.7 to 3%. And, we got a question here on commodity pricing and specifically what's going on in China. Industrial production in China is beginning to fall off. There's going to be a substantial easing in commodity prices over the next couple of years. Now, my sense is, Devika, while you always want commodity pricing increasing if you're in Australia, it will create space via the inflation channel for the RBA to respond in a timely and appropriate fashion should those risks materialize to the upside, which is why, I think it's important to say, hey, Australia's inflation rate is just not as bad as everybody else's. And it's wise to move forward on a prudent fashion, whether you're talking about fiscal or monetary policy, because the US is going to be constrained. The UK, Canada are going to be constrained, as will both Brazil and India, which have very different inflation dynamics than developed economies.
So Joe, you're talking about the US and inflation. So there's in the 70s, we had unemployment going, surge in inflation. That's not something you perceive happening. What's your view around that, just in terms of that volatility?
It's premature to
Yeah,
compare what's happening now to the 1970s. The Great Inflation, 1965 to 1985, occurred because of a unique confluence of events around the Vietnam War and what was called the Great Society, or a massive increase in fiscal spending over many years in the United States. We're basically just recovering from the shutting down of the global supply chains that caused a 2-year move from 1.5 to 9.1% in inflation. And we moved back down on the eve of 2025 to around 2%, right? Now it's increasing because we've got expansionary fiscal policy, we've got trade conflict, and other things that are occurring, especially a very robust set of demand from wealthy individuals in the United States, uh, driving very sticky and stubborn service pricing. Now, there are certain things that you want to watch if you're a participant in global financial markets. In particular, should dynamics at the front end of the Treasury curve in the United States result in the 3-year Treasury moving higher than the federal funds rate, you could see an avalanche of reserves on balance at the Fed roll into the market. We would need to see specific conditions like that, Robert, to create
that situation.
a real risk of something like we saw in the 70s. Many of you out there think money supply equals inflation, always and everywhere. That's simply not the case in the global economy. It can under certain conditions. But right now, those conditions are not approximating and they don't look like they're going to obtain. But we do watch financial markets in a very granular fashion.
Yeah,
So that's where the risk lies, at least for the next couple of years.
yeah, that's good. Thanks, Joe. And we've been talking about some of the traditional economies, commodities particularly. What about digital currencies and the emergence and how that's evolving globally, particularly in the US, and how that could reshape some of the factors impacting on the global monetary systems and the role of the US dollar? Could
Yeah.
things such as regulated US stable coins strengthen the dollar's influence? And what might this mean for liquidity, capital flows, monetary policy? Because that's something that is emerging and continuing to have a greater influence.
So when we talk about digital currencies, there are two things we talk about. There's crypto and there's stable coins. Okay, when I think about currencies, unit of exchange, or excuse me, medium of exchange, unit of account, and store of value. Bitcoin, crypto are none of those. There's nothing, I can't go buy a house or a car or my groceries with Bitcoin. And we've seen Bitcoin come off significantly recently. It's the third time in 10 years there's been greater than a 30% crash in the value of what charitably can be called a speculative asset.
Yeah.
Not so charitably a voluntary Ponzi scheme. That's just a place to play in the great global casino. If someone's willing to take risk and lose all their investment capital, that doesn't bother me, right? It's just like a good weekend in Vegas. Sometimes it goes well, other times it doesn't. You just prefer to forget it, right? Now, stable coins are different. Stable coins are based on the value of the dollar and linked to US treasuries, right? And I'm just old enough to remember when both crypto and stable coins were supposed to replace the dollar. That's simply not going to be the case,
Yeah.
right? Now, there's central bank digital currencies. The Chinese are experimenting with it. The Europeans are expected to begin experimenting with it soon. We'll see how that evolves. My sense is central bank digital currencies may be the future, but well over the horizon, right? Now, on the dollar's reserve currency status, right now there simply is no alternative. Something that's little known outside elite financial market participants is that at the close of every day, the banks have to all balance their trading sheets.
Yeah.
And if something's not in balance, they have to put up collateral. The only collateral that's accepted are U.S. Treasuries.
Yeah.
More or less at the end of every day, there's a $12 trillion of settlement.
Okay.
Now, over time, perhaps Europe, perhaps the Chinese, perhaps the Indians, perhaps the Brazilians will step in, liberalize their currencies, and provide an alternative to the global financing that's now only able to be provided by the United States, right? When that time comes, we can have a much more in-depth discussion about a truly multipolar financial world. But today, it's a unipolar financial world.
Okay.
There's just simply no other alternative. Now, what does that mean? What it means is the U.S. reserve currency. It can maintain and run higher deficits and support higher debt than it would if it was not a reserve currency. You can take a look at what's been happening in the UK over the past decade to give you an example of a country that needs to engage in fiscal consolidation and a reduction in annual deficits and a move to basically balance what's called their primary deficit, which is the deficit X interest owed on past debt. It was a very painful process that the Italians actually had to go through over the past decade and have gotten there, right? It's why the British have a lower debt to GDP ratio and lower deficits than the Japanese, the Italians, than even the Americans, but they pay a higher interest rate. The global integration of finance is not going to go away despite Mr. Trump's trade war.
Yeah.
The advanced integration of the big banks that operate globally require a currency that can be used as a reserve currency, as a medium of exchange, and a store of value, and a unit of account. Crypto does not do that. Bitcoins do not do that. And until there's another global currency that rises, and it may, probably not in my lifetime, but maybe in Devika's, these are all just very interesting academic discussion points that can get us on TV, get us quoted in all kinds of news sources, and maybe even publish books around. But right now, it simply just doesn't matter.
Doesn't matter. Yeah. Good. Thanks, Joe. Devika, the one of the things that really affects Australia is tariff retaliation was to perhaps just increase, or that volatility with China and its other trading partners. Which sectors would be most exposed in Australia, and why? If that rears its head.
Yeah, so I think some of them, so I'll divide the sectors by the ones that do businesses once goods and services leave Australia. And then there's this other sector which works very much inside Australia, impacted by China. So let's look at the sectors inside Australia first. Most importantly, retail and hospitality. I was in South Australia a couple of months ago, speaking to our clients in Adelaide. And one of our clients actually mentioned that the impact of Chinese tourists on these sectors is so instant. Every time there's a bit of a scuffle, whether it's with China and the United States or with China and Australia, the Chinese tourists and Chinese students, the flow of Chinese tourists and students falls sharply. And when that happens, consumption falls extremely fast because, believe it or not, Chinese students and Chinese tourists are actually bigger spenders than local Australians. So the retail sectors and the hospitality sectors would be at the receiving end should things go awry with China, with the United States. Perhaps if things get tough for China, as Joe mentioned, China is in a particularly precarious situation where it does require a lot of fiscal stimulus to keep the economy moving. When we are in such a situation, understandably, the government would like people to spend money inside China rather than get all the capital flowing out. So when there's a curb on spending outside of your national borders, Australia being one of the most preferred destinations for both tourists and students alike, we can expect the retail, hospitality, as well as the education sector to suffer quite sharply. Of course, the education sector is still fairly insulated because we have a huge chunk of Indian international students also coming into Australia. So that could potentially offset the impact on the education sector. But I do not see that happening in retail and hospitality because Indian tourists do not spend as much as Chinese tourists do. When it comes to goods and services leaving the Australian shores and reaching China, we are all aware that China is our largest trade partner. It's our largest consumer partner. Agriculture and agribusiness. We import a lot of our food core commodities to China. Again, the same concept applies here. If there's tariff retaliation from the partners, people decide to move away from China or people decide to move away from the United States, a point that Joe raised, that it's become very fragmented. It's now become us versus them. And who does Australia cozy up to? Does it cozy up to the United States? Does it cozy up to China? Now, that's a very tough spot to be in. So we do see risks to agriculture and agri-food because wine, beef, barley, seafood are all some major exports that go from Australia to China. Concentrated China demand, so it's easy to target those with quotas and tariffs, and substitution risk is very high. So that's one challenge when it comes to this sector. We did touch upon education, tourism, bulk commodities, thermal coal, some base metals, and also critical minerals. I think critical minerals is at the core because lithium processing is at the core of critical minerals. We are aware how dependent China is on Australian iron ore. And given how weak their construction sector is, understandably, the demand for iron ore is likely to get a hit. But that can be offset by lithium processing because now China has moved from manufacturing or from its focus on construction to manufacturing.
Yeah.
And for manufacturing, they're focusing predominantly in the EV space. And for EV, we need batteries. And for batteries, we need lithium. So luckily, again, for us, Australia is one of the leading producers of lithium. Interestingly, the way China invests in lithium processing here is it does not directly import lithium from Australia. It invests in lithium mines, processes lithiums, and then ships them off at much cheaper rates back to China. So the model is very different compared to a traditional export-import model when it comes to processing critical minerals such as lithium. So these are some of the core sectors, I believe, which could be exposed. We did see what happened as soon as the tariffs were announced and how much of an uncertainty surrounded these sectors. And it continues to be these sectors going forward because they form the core base of Australia's import-export with China and with the rest of the world. While it is very easy to divert your trade from China for goods such as seafood, barley, maybe you could just move them away from the United States, China, direct them more towards India, Vietnam, or any other APAC country or Europe for that matter. Core commodities such as lithium are very China focused, extremely China focused. So it's very hard for us to actually diversify that risk that comes from a fall in Chinese demand.
Yeah. That's good. Thanks, Devika. I might just move to Joe just in terms of US total debt. And just for government or semi-government in the US, Joe, could that level, the level of indebtedness, push the US towards some financial or economic collapse in the future, or are we sort of misinterpreting that level of debt at the moment? What's the assessment? What's your view?
I think we're misunderstanding what that level of debt means. Okay, because we have a $30 trillion economy, right? And as long as the U.S. current dollar is the currency reserve, we're simply not going to have a currency or debt crisis, right? There would need to be another alternative constructed or some sort of large exogenous event that would involve a massive transfer of capital out of the United States and a reversal of these capital flows, right? So it's an interesting thing to talk about. The U.S. debt needs to be put on a sustainable path. Again, the best thing for the United States, in my estimation, to deal with this would be to engage in a period of fiscal consolidation where it puts its primary budget on path over a 5 to 7 year period to zero, meaning the interest owed on past debt, or excuse me, all interest, just put that primary budget, excluding interest on past debt, on a path to zero and get to a point where growth is advancing at a greater pace than the increase in debt. And those dynamics will be fine. Again, I want to reiterate this every day. When we
Yeah.
close up shop, we get 12 trillion moving, all in treasuries.
Okay.
Whether it's Australian banks or US banks or European banks or Japanese or Korean. Yeah. That's the hard facts, the facts of life and the
Yeah.
plumbing of the global financial architecture. For financial market economists such as myself, that's where the day starts and ends.
Got that balancing event.
Yeah, that's right. And it can't literally be talked around.
Yes.
Yeah, those are the facts of life in global finance.
Yeah. Thanks, Joe. But Joe, you mentioned this earlier. This is maybe a question for both of you. Escalating, well, we've got the situation of potential escalating US tariffs, particularly those China. It seems to have settled down in other areas. Electric vehicles, which you mentioned, Joe, which we're seeing that in Australia, flooding the market and numerous brands, other strategic technologies, and how they're influencing global supply chains and trade flows over the next 12 months. How do you see that playing out? This question for both of you.
The Chinese have overproduced electric vehicles.
Yeah.
They can't absorb them domestically. They need to find developed markets to accept them. Well, they're cheap, $16,000 US. The average US car for sale is 50,000. They're simply not going to be flowing into Mexico, the US, or Canada. They're going to be cut off at one point in Europe. I had a business trip that took me from London to Paris last month. I use Uber to get to and from business meetings, and I got to ride in the Chinese EVs. They are quite attractive, very interesting. But the Chinese, as they often do, whether it's diplomatically or financially, they see a tsetse fly on the table and they drop an anvil on it. It kills the tsetse fly, but it also destroys the table, the floor.
Yeah.
Well, they've got themselves in a pretty pickle here, where they've just got excess capacity inside China. It's not inflation, it's deflation, because there's just too many goods with not enough money chasing it, as their youth unemployment is high, as wage growth has stagnated. And while we talk about the official Chinese statistics, one gets the sense that at the end of the day, the Chinese growth path, which everybody got used to 10%, now talking about 5%. Within the next 5 years, it'll probably be closer to 2%. And China's caught in what economists would call the middle income trap. And they're going to go through a very, very difficult adjustment as they repair both private and public balance sheets. I don't mean the country of China, but the prefects and the municipalities, households, and commercial firms are just proceeding through a very painful deleveraging, much like what was seen in Japan over a 30-year pace and 2007 to 2014 in the United States. They are caught in it. Their banks are not well positioned to deal with it, and it's going to take a lot of time. Should they continue to flood global markets with overproduced goods, trade protectionism, and demand and acceptance of Chinese goods will unfortunately narrow in a very significant way, right? This is why India is stepping into the void. This is why Australia is attempting to diversify its portfolio, right? Devika, great points on lithium. I wouldn't be surprised one day if the US steps in and begins to buy a lot more lithium from the United States as China's demand falls, because they're going to need to pare back on their production.
I think just one thing I would add to this entire electrical vehicle experience would be something that we are experiencing in Australia already. I think Joe was right to say that we have already been flooded with a lot of Chinese branded EVs, which are actually quite attractive. I mean, BYD, we see a lot of Ubers now being BYD. We've had Chery also coming up with its own EV. But one constant experience that is being shared is, yes, the cars are cheaper. Yes, they are really good. And EV being EV, more cost efficient compared to fuel in Australia, given how pricey fuel is. The challenge with Chinese EVs is they do not have good infrastructure for servicing.
Yeah.
Yeah.
So whenever there's an issue, you either have to be without a car for a good 2-3 weeks, and it's okay to be in that position if you have another car to fall back on. And I'm not talking about families, I'm talking about people whose employment depends on EVs.
Yeah.
So for the drivers, for example, say Ubers and just delivery drivers or whatever it may be. So that's a huge hit to their business. And that takes a large chunk of revenue off of them. So while everyone jumped the gun and have indeed bought a lot of Chinese electrical vehicles already, it's only now that they have started experiencing all these pains going 1 or 2 years into that Chinese EV investment, where they are facing these hurdles of not being able to service them on time, facing issues when it comes to logistics, just facing this issue of not being able to move ahead in their business models as smoothly as they thought. I mean, they tried to save costs by going for a cheaper EV option,
Yeah.
but the costs have now materialized differently in their business model. So that's another risk that people are coming face to face with it.
Yeah. Yeah. They're certainly much more prominent in Ubers and others. We've all seen them. So that's just going to be interesting how that plays out in the future, but also in the secondary market if there is a secondary market for those vehicles. So that'd be
There
interesting.
really isn't, Rob. Bob, that's a great point. It doesn't matter what electric vehicles its origin is. 5, 7, or 10 years out, you have to replace very expensive technology, and the fundamental value of that automobile shrinks to close to zero, right? Which means global EV production is predicated on a lease, not buy, and that's not every country. One thing I want to make sure, because we're coming up on the end of the hour here, developing markets. There's been a big turn out there, people. For the past 20 years, nobody at the banks wanted to work in developing markets, emerging markets. It was a career to nowhere, right? Over the past couple of years, localized debt markets have begun to emerge and evolve. Things are really beginning to take shape in both emerging markets and the frontier markets, sometimes because of oil, sometimes because of commodities, sometimes because of institutional liberalization and reform, which allowed localized debt markets to begin to develop. I really think as we go forward, not just as RSM, but in Australia, even in the United States, and overall all over the world, we're going to be looking at emerging markets and these frontier markets in very different ways. And I think that's one of the understated tailwinds we might see during the remainder of the current global business expansion. And that may be the number one story in the next one.
Something to watch, Joe. It's very good. One of the things that we have spoken about, and we had Devika and I were joking about this maybe a month or so ago. We had a productivity get together with key leaders throughout the country, and they were talking about productivity. Then it went quiet. We were waiting to see what emerged from that. Lagging productivity is an issue in Australia, and I know in other developed economies like the US as well. What structural issues are most responsible, and where do we see the greatest potential for improvement in productivity that our clients might be considering? What indicators are you seeing, Joe and Devika, in that productivity space?
Typically, in economies that aren't in possession of reserve currencies, it's structural impediments to business fixed investment due to the crowding out of private investment. Basically, during the long period of zero nominal interest rates on a global basis, many of the developing economies didn't undertake the structural reform they needed to. They didn't put in regulations and rules to unlock innovation in their economies. And now that we're going to have higher inflation and higher interest rates, there's going to be a price paid by economies that are just less productive, right? I'll use Europe and the UK as an example. They sit on innovation. The cost for taking risk is simply too high. The banking rules and regulations do not support risk appetite or risk taking. And what's occurred is 25 years ago, when neither you or I had gray hair, Robert, the European Union economy was slightly larger than that of the United States.
Yeah.
It's now 1/3 smaller. And the United States is on the cusp of a significant technological transformation that Devika and I may one day look back on and call it a positive productivity shock.
Yeah.
Okay.
While the rules, regulation, and framework around AI are all supportive of that. Yes, we may be in something of a bubble right now,
Yeah.
but not all bubbles are bad. Both Devika and I were trained to be central bankers. It's impossible to identify a bubble. I've got my metrics that will tell us, yeah, we're at risk of a contraction. Sure enough, we were down 5-6% real quick, right? Because of a reassessment of risk taking, specifically around those 10 large companies and circular financing, in particular inside NVIDIA, and how they would finance companies who would then buy their chips, right? The structure itself is so small, it's unavoidable as it scales up, right? Because it will take literally decades to achieve scale where that doesn't happen. So we're entering, Shakespeare's undiscovered country here.
Yeah.
We're going to find out which economies can adapt to innovation and can create a regulatory matrix that supports it, both financially, right, and in a larger policy sense. And to me, that's this younger generation that's moving into power. That's going to be their business challenge. Because the last thing you want to do is fall behind both the United States and the Chinese.
Yeah.
For to add a bit of an Australian angle to this, I think it's very similar to the point Joe raised about the European Union's not being big risk takers. And this is something I did speak with our clients in Brisbane just a month ago, where we did identify that Australia in general, technology or any kind of technological advancement usually reaches Australia 2 years after it's reached the rest of the world. For whatever reason, I think it also has to do a great deal with the fact that we are quite isolated geographically. So the businesses are more inward looking than more connected to the rest of the world, which means the risk appetite is significantly lower in comparison to the rest of the world. There's absolutely no comparison with the United States if we are to look at technological investment, because it's very different. The entire business environment in the US is very different to what we have in Australia. We also have we are probably a bit more agrarian in certain sections of the country, a bit more service oriented in other parts of the country, and less technologically driven. And that can be evidenced by the fact that R&D investment usually lags in Australia in comparison to the rest of the developed world. Manufacturing usually lags in Australia compared to the rest of the world, and R&D and manufacturing are some of the core industries that we should be focusing on. Another challenge we face in Australia is there's a huge disconnect between what is offered at universities and what is required on the job. And that gap is something that needs to be fixed by communication between the educational institutions as well as business bodies. When they come together and when both parties are able to identify the required skill sets and what form of education needs to be imparted so that the young graduates that come out of Aussie universities are jobs ready, is when we can see a bit of a change in the lagging productivity metrics. Also, a lot of Australian students are not keen to pursue university education because it's quite expensive. They prefer going into apprenticeship. So this is where organizations such as TAFE come into place. So they have immense potential to actually support this growth in education and making sure that Australian graduates or Australian school leavers are actually equipped with the right technical skills to enter the jobs market quicker than students having to spend a lot of money on university education. This also brings us to the challenge of dependence on international students and the consequent immigration problem that we are facing in Australia. So migrants are both good and bad. I think, look, if we are to look at how they increase the denominator, we can say that they do result in per capita recession because the denominator has increased. But at the same time, the increase in denominator and the increase in migration is exactly what has kept the economy afloat. Because when local Australians weren't spending during the peak of the pandemic, it was the migrants who had entered Australia who kept the economy moving, the engine moving. So it's very important that we fix the structural issues at the core of Australian productivity, which is a lack of available skill set, the gap between the education that is provided at universities and the skills required to be job ready, and at the same time, investment in technology and upskilling your existing staff. That is what is going to help us bridge those productivity gaps.
Yeah. Okay. Thanks, Devika. Now, maybe one final one for you, Devika. Just many of our clients are talking to us all the time about big decisions they're about to make around capital expenditure, and they're looking for, short term, what macro factors should they prioritize when making those decisions? If they're looking for signals before they launch into big capital expenditure, what do you suggest we keep an eye on?
I think most important would be where rates and credit are. Understandably, what the trajectory of the Reserve Bank of Australia is, where term premia lies, and it's important to lock funding early if the spreads are expected to tighten. It's also, look, given how inflationary generally things have been here, particularly for businesses, I think the real risk is that there may not be that big a need for capex, but the prices that they are going to have to pay for each investment in the business is going to be higher.
Oh, yeah.
So there's going to be an inverse relationship between capex and prices that are expected to be paid if this is how we are going to go ahead.
Yeah.
So most important is where interest rates are going. Inflation mix, of course, goods, services, those are all imbibed. They all come in one package. And
Yes.
inflation is directly linked to demand. Where exactly is the demand? What industries are likely to, so it's a cycle. There are some sectors that are going to flourish, that there are some sectors that are going to take the hit. So if you are able to adjust, or if you are able to diversify your business in a way that you are able to capture the right market at the right time, then that is one thing you need to keep in mind when it comes to capex and planning for 12 to 18 months ahead. Regulatory permits, I think red tape is something that businesses continue to face in Australia.
Yes.
Now, when it comes to regulation, of course, it's very important to be on top of the ever-changing policies. And if you feel there is going to be a significant roadblock when it comes to certain industries, certain sectors, or certain investment measures, better to steer clear. Even though you may have locked your funding, just steer clear.
Yeah, that's good.
I do like how how Devika unleashed her inner central banker there. And I do hope both the RSM Australian partners and the audience out there took to heart the focus on credit quality and credit spreads, especially to 3, 5, and 10-year intervals. If those are favorable, you have to act. You cannot fall behind the curve, because I can tell you what's going on globally, and you got to keep up.
Yeah, that's good. That's great. Thank you, Joe and Devika, for such thoughtful and timely discussion. It's been really great. And Joe, particularly thank you for you. This is Thanksgiving in the US, and taking time out. I know that's a special time, so happy Thanksgiving to you. And judging by the questions and the reactions, we've had a great interaction. Thank you for everyone who's joined. Before we end, I'd appreciate if you could take a moment to complete a short survey that's popped up on your screen there. Your feedback really helps us refine these sessions and hopefully continue to make them of value, that you can perceive some value and take them as cues in terms of major decisions that you're making in the future. If you'd like to watch a recording of the webinar, it will be available shortly, and we look forward to seeing you at our next update. Have a great day. Have a great Christmas that's coming up, and festive season for everyone. Have a good break. And thank you again, Joe and Devika.
Thank you.
Thanks so much, everyone.
Thank you.